So very good afternoon to everyone, right? So starting the FM revision series, right, for the September 2025 exam, right? The day one part will be NPV, your theory chapters plus working capital management, right? Day two will be your forex risk management, forex plus interest rate risk management, correct? Then you have business valuation also, plus business valuation. Last day, I think you've taken WSCC and the weighted average cost of capital, sources of capital, remaining part. So this is how we will go about with the lectures, right? Correct. So that is how it will be, right? So these will be the topics, right? What I will do is it will be a quick fire revision that will happen, right? Once the quick fire revision happens, right? Whatever questions I'll give you important questions that can be done, right? And if possible, take one or two questions in class, right? Which I feel are important, correct? Now quickly let's start with what FM functions may I don't find too much to be challenging, correct? So quickly let me complete what the FM functions part, the basics of FM, right? The basic of FM, the definition of efficient acquisition, efficient allocation, which fulfills the objective of the company. Objectives of FM are primary and secondary objective. Shareholder wealth maximization is the primary objective. Secondary objective is profit maximization, market share increase, EPS growth, revenue growth, geographical location growth, right? Social responsibility and customer satisfaction. What are financial objective? What are non-financial objective? I've already marked that. You need to know what the basic profit format is. Correct? The basic profit format has to be like this. The format, I don't know whether you know it or not, but that format is has been very helpful and can help you in exam to know. Here we have done basic EPS formula, dividend per share formula. EPS is nothing but EAESH, that is earnings attributable to equity shareholder divided by total number of equity or ordinary shares. Dividend per share is 5 million, or dividend per share formula is dividend paid in total divided by total number of equity shareholders. Then three decisions: financing, investing, and dividend decision. From where will the money come? Financing decision. Where it will be invested? Investment decision. Correct. And what? At the end, dividend decision. Correct or not? Have a look. Stakeholders, internal, external, and connected. Right. External or connected are generally in the external part. Internal are directors and employees. Correct. Competitor, supplier, debt holder, equity shareholder, customer are connected. Then you have your government, regulator, society at a large, and pressure groups as what? External. All stakeholders are not shareholders in a company, but all shareholders are stakeholders in the company. The equity shareholder or principal or agency theory, which says that principal appoints the agents and agent acts on behalf of the principal with the third party. Anything happens, principal is responsible, correct or not? Then there is very important question of, or a very important formula of TSR. TSR, total shareholder return, right? So total shareholder return tells you what? What is the formula for TSR? TSR is nothing but interim dividend plus final dividend plus bracket में share price at the end minus share price at the beginning, the whole divided by share price at the beginning. It gives you how much return, right? Should be what? Earned, or how much is earned by an investment that is done. Generally, it is a yearly what? Tell me scenario, right? Then managerial remuneration, I think I've given. Going ahead, corporate governance, right? 4 or 5 things about corporate governance. So that I will come back to later on. Aja. Treasury function is an important sir. FM environment. This will go back when we go. First, let's complete what? Investment appraisal and working capital. At the end, we'll take up the remaining theory. Aja. Investment appraisal is quite a big of a portion, around 30-35 marks, right? You can expect from this. A section C question. Now see, a lot of you say that, sir, section C mein to full-fledged NPV will only come, correct? Generally, I see students full-fledged NPV, but mind you, right? Examiner's favorite right now is asset replacement decision, lease versus buy. EAC and capital rationing for section C question, and recently so even ROCE payback NPV IRR Melplash company question, right, was also done here. And don't be surprised if you see what, tell me, ROCE payback NPV IRR again being asked in what, section C. Annuity, perpetuity and relevant cash flows, not much can be asked there from section C, but yeah, small implications of these on in section C is always there. Full-fledged NPV obviously is favorite, right? Generally, I see that if there are 2 or 3 sets of papers, correct? So one set has full-fledged NPV, right? This time around, I think in your exam, correct? Full-fledged NPV came as what? Section C question. That is your mock exams, correct or not? So don't be surprised if you see a question on this, or you see a question on this asset replacement decision, that is these versus buyer, EAC and EAB, or maybe ROC, or one time, right? One question, I think ZM or company or something, I don't remember the name, but capital rationing is also a question can. Correct. Then the basic what? Your future value and present value formulas that we have done, correct? Right? No. In the, I would recommend what? Tell me, use is equal to IRR formula, right? It is said in the examiner's report. So she's asking that IRR was asked for 3 marks and they did by pen paper method. They have to do suggested answer may when what you have to print the answer, you cannot do is equal to IRR, but the answer has to be done by is equal to IRR, right? When we come to that part, I'll give you time at the end for your queries. Okay. So quickly, Ajam, the time value of money, the future value by simple interest method. The formula is future value is present value into 1 plus interest rate into number of years, correct? And if it is compounding formula will have what? Future value is equal to present value into 1 plus interest rate raised to n. N is the number of years or number of times the interest rate grows, correct? Then going ahead, you have what? How to get the present value from that? Present value is nothing but your future value, what? Multiplied by 1 plus r raised to n, correct? Or you could, we have derived this formula here. If you want, you can see the derivation of the formula here, right? Then we went into generally, I start with ROCE, return on what? Capital employed. So the basic formula of ROC is ROC by initial investment and ROC by average investment. And when I say ROC by initial investment, it means average PBIT divided by initial investment. And when I say ROC by average investment, it means average PBIT divided by average investment. Average investment means your what? Tell me. Initial investment plus scrap value divided by 2. When I say average PBIT, so generally a question will be that boss, there is one investment into what? A project or a machine which has a life of 4 years, and maybe cash flow or PBIT of that is given, correct? Or operating profits is given. PBIT is nothing but net operating profits. Net operating profits means whatever you are earning from your business 4 5 years, and then you take an average of it, correct? Average of it would be, now see here, PBIT of 4 years given. You take an average of it, take it here, and then divided by the initial investment of the machine or divided by the average investment, right? So ROCE by initial investment and ROCE by average investment, right? Both the options are open to you. Correct or not? Have a look. But when it comes to what? Tell me. When it comes to what? Tell me your cash flows. So if you have to go from cash flows to profits, right? So cash flows to profit, only one thing that is there, that is depreciation, that is there has to be deducted to go from cash flow to depreciation. Have a look. Cash flow to PBIT for ROC calculation. What do? Depreciation will be deducted from the cash flow because you have to take net operating cash flows. From net operating cash flows, if you have to go to operating profit or PBIT, you have to deduct depreciation because the depreciation is a non-cash expenses which is deducted from profit but it are not deducted from cash. So if you have a question like this, correct, I would recommend that if there are operating cash flows, calculate depreciation of every year, right, on SLM basis and deduct it from the cash flow. You will get the operating PBIT that is there, right? Have a look. Then ROC by average investment you can calculate, right? So this is one type of question that has come up. But it will so be that average PBIT will not be calculated if multiple data, if let's say only a single year data is given. In that case, what you will do? Your PBIT divided by the what? Capital employed. Your capital employed will be nothing but equity share capital plus reserves plus non-current liabilities. Book value of that will be taken. Correct? And the other part of it, right? One more thing. It is also called as the accounting rate of return. ROC is also called as what? Accounting rate of return. ARR. So in the exam, if they ask you calculate ARR, that means calculate ROC, right? And then decision criteria basically is wherever higher ROC will be there, right? At that rate or with that project which has higher what ROC will be selected. Then coming to payback period, the basic payback period. The basic payback period is very simple and straightforward. 100 you invest today, in how many years do you get back the money? Correct or not? So you use the cumulative cash flow method, right? You go on adding the inflows, right? Where you reach zero is nothing but your payback period. Correct or not? Have a look. Then at times, right, payback period is asked in two ways. That means 2.5 years, 2.3 years. In that case, how will you calculate when it happens or the payback happens between second and third year? How will you calculate? 2 years is already there. So your 8 answer is coming. So what you will do? How much is received within third year? That will be in the denominator. And how much you want to receive in the third year for going to zero, right? So 40 divided by 48 will give you 2.83 years. But if it is asked in number of months, this 40 by 48 into 12 you have to do. So you get somewhere around 9.9 months. Always round up the number of months is what the ACCA has told, and most of the books recommend. Correct or not? Have a look. Wherever payback period is lower, we would choose that option. Correct or not? We will choose that option. Have a look. Payback period. Then coming to net present value. Net present value is nothing but you finding what? Tell me. Present value of what? The future cash flow. So what do? You have an initial investment, correct? So you have three options of what? NPV, right? NPV positive, NPV negative, NPV zero. When NPV is zero, that is the rate at which NPV becomes zero is your IRR. Barabar. Now when we look at NPV, correct? The present value. So what you do? You take the initial investment and take the sum of present value of all future cash flows. You pull all the cash flows and bring it to 0 year. And what? Compare it with what? Tell me. Your 0 year initial investment. If the present value is higher, that means if you have a look here, right? That is initial investment is lower and sum of present value of all future cash flows is higher. Then what will happen? A return of project, right? Or I can say NPV is positive, right? And in this case, IRR, that is return from the project, is greater than the cost of capital. Cost of capital is nothing but the discounting rate used to discount all the cash flows that are there. Whenever you have positive NPV, it means shareholders' wealth is maximized. Correct? But if your initial investment is higher and sum of present value of all future cash flows, okay, generally they have to be cash inflows. Initial investment generally will be negative. If initial investment is higher and sum of present value of all future cash flow is lower, in that case, what will happen? The NPV is negative and you will reject the project, right? The return of the project will be lower than the cost of capital. Cost of capital or discounting rate is nothing at what rate you are getting the money, and IRR is nothing at what rate you are earning. Your shareholders' wealth will reduce. And when it is what? Almost NPV is equal to almost never, NPV is equal to zero. That is the IRR rate. In this case, generally we reject the project, right? And look at other factors, right? That is initial investment is equal to sum of present value of all future cash flow. Correct? No change in shareholder, right? Have a look. So this is something that I have done a lot of what practice. But if you are at this position, NPV should not be a very big problem for you. Yeah. But when it comes to NPV, right, generally they play around with words, right? Today, start of year one, in advance for year one, all is year zero cash flow. Year one cash flow is end of year one, start of year two, or in advance for year two, or in arrears for year one. All these wordings mean first year end. Correct? And respectively for second, third, fourth. Correct? Have a look. Then discounting always for 0 year will be 1. Correct? And rounding of principal is generally 1 to 49, you will round off to lower side. 50 to 99 will be rounded off on the upper side. So whenever it says rounding off, these principles will apply. But if I say round up, 17.01 will be 18, right? And when I say round down, right, that means 17.99 also will be 17. That is how round down and round up logics work, correct? Sometimes you will be given what? Dollars, thousands, right? So rounding off given. So if it is 1,000 or let's say 17,499 to be rounded off to nearest thousand, that means it will be 70,000. Barabar hai. If it is 17,501, it will go to 18,000, right? Then analysis of NPV. If initial investment goes up, NPV falls. If initial investment goes down, NPV goes up. If cost of capital or discounting rate goes up, NPV will follow. If cost of capital falls, NPV goes up. All these what analysis are very important to answer theory questions. Future cash flow, if they go up, that means the value of the future cash flow increases, NPV increases. If the future cash flow goes down, NPV decreases. So analysis of NPV for analyzing NPV and doing what? Calculations, right? Rounding what? Rounding off means what? Basically 0 to 49, right? It will be rounded to 0. 50 to 99, it will be rounded up. When I say round up, 17.01 is 18. When I say round down, 17.99 is 17. Correct? So that is how things work out. IRR, internal rate of return, right? There are two ways of solving IRR. One is by the pen and paper method, which should be used logically. The examiner takes an approach that you use it in section A and B. IRR is equal to lower rate plus NPV lower rate, right? NPV lower rate divided by NPV lower minus NPV higher. This minus sign is very important because this NPV higher generally has to be negative. So this negative plus this negative generally becomes positive, multiplied by higher rate into lower rate, correct? Have a look. This is equal to IRR. This is an appropriate, this is an approximate answer, correct? And when you go to spreadsheet method is equal to IRR, reference upon discounted cash flow of project from now to end of project, right? So from 0 to end of project you will take, correct? Right? And it will give you an IRR answer, right? Is equal to IRR, right? Now this is called as the interpolation method. Between two poles you are trying to find a value. That is the interpolation method. Then there is a spreadsheet method, correct? Both the methods of IRR are important. Now coming to what? Tell me the most important part, right? Advantages and disadvantages, IRR, right? Now see IRR के बाद you have IRR and cash flow analysis, correct? Yeah. This I think conventional cash flows you have one IRR, correct? But when there is non-conventional cash flows, non-conventional with type 1 non-conventional cash flows are what? Negative, positive, negative, positive, negative, positive, and ending with a negative. Generally, you have no IRR or one IRR possible, correct? But when it is type 2 non-conventional cash flows, you have negative, positive, 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 and at the end negative. Start with negative, end with negative, and positive in between. Generally, you have no IRR, either you have one IRR or two IRR, that is multiple IRR problem will always be there, right? So for that, if you want to check out, I have given a lot of examples, right? So you can try that, right? Then going ahead, methods of investment appraisal, you have four methods. We have what planned out all the four methods, correct or not? What to use when, correct? Right? Best method is NPV, right? When given a question, NPV should be, or that method should be chosen, right? Then advantages and disadvantages of what? Now see here, when it comes to NPV, IRR, payback period, ROC, honestly, I have given in the shortest of the detail possible, correct? You, even if you read this sheet, right, more than enough, right? One, either what NPV versus IRR or advantages and disadvantages of IRR and NPV are asked, right? Most of the times that question is something, but you cannot deny the fact that ROC payback period as a theory question in section C cannot come up, right? Or maybe a section A, B, MCQ mein ROC or payback period does not come up. 100% I have seen those things come up in exam. So I would say just read it and memorize it once. If you have not yet done it, I would really recommend you to do it, correct? Blank theory. I cannot help you too much into this, right? But one question from this you can always accept. If generally NPV ka question comes up, it will always be NPV versus IRR ka question, right? Then further analysis of NPV, have a look. Project A and project B, correct? Have a look. So for comparing two projects on NPV basis, you need to have what initial investment as same in both the projects. Discounting rate of COC is same as both the projects. Project life has to be same, and we can compare two projects with differing life. Wow, equivalent annual benefit when we do asset replacement decision. So generally, to compare two projects, initial investment, life of the project, and discounting rate have to be same. If those are not same, it's difficult to compare two projects. Now, I have done a lot of practice of theory MCQs in between. You can have a look at the theory MCQs, no tension. Then we came to annuities. Annuities is nothing but the same cash flow, even cash flow repeated for n number of years. N number means the number of years that are finite number of years. So basically, you have the basic annuity, correct? Then you have annuity starting later. Then you have annuity starting now, and then you have annuity and IRR, right? The basic annuity starting from year one, annuity starting later, annuity starting now, and annuity and IRR. Have a look. So basic annuity is nothing but cash flow or same even cash flow repeating from year one up to year 5. Example. So it is repeating what 5 times, right? So the basic formula for annuity starting now would be basically, have a look, the annuity factor or your cash flow into annuity factor, right? Whatever annuity factor is nothing but the percentage that you have of discounting, comma, how many times the what? Tell me. Cash flow is repeated. Have a look. If you want to find present value of a annuity starting now, and when you compare it with the initial investment, you can get NPV of that part. Then it is annuity starting later. I think I've taken. So it's not does not start from first year, but it starts from third, fourth year. In that case, we use the flagging method. Nowhere is flagging method used anywhere, correct? Right? So flagging method, this is something that I use word flagging method. Nowhere in any book flagging method is used. Generally, annuity starting later, what do you do? From whichever year your annuity starts, or first you to put up a flag at the last year when the annuity ends, and the second flag at 1 year before annuity starts. You take annuity factor from the annuity table of both one, and last wale mein se you, or first flag minus the second flag multiplied by the cash flow gives you what? Tell me. The sum of present value of the annuity that is there, right? Annuity starting later. Now this first flag, second flag, Chinmay Shah production. Nowhere in any book it is going to be there. Neither flagging method is even a method that is taught anywhere in the world other than in my class, right? Method 2 is a logical method. You go 1 year before the annuity starts, pull all the cash flows normally, right, as an annuity, and then from second year you take it to 0 year. That is a logical method, correct? Where you discount at the end. Both the methods are acceptable in exam, but most of the questions are solved by this in section A and B. So I generally say in section A and B, this can be used, or this should be used, correct? Then annuity starting now is what? From 0 year only annuity starting. So from 0 year only you get the money. So what you do? 0 year you forget everything. First to whatever years, correct? You have the annuity, you bring it to 0 year, correct? And then add the annuity or add the cash flow that is at the start, right? So you can have a look at the formula. Even cash flow tending to n years into annuity factor, discounting rate percentage n minus 1 year plus the even cash flow that is there. So this is something basic annuity stuff that is there. Then annuity and IRR, one of the most difficult topics, correct? Of what? Tell me. Theory MCQ, theory nahi, in your questions, right? To identify this question and solve it is one of the most difficult questions, right? So IRR and annuity is what? Now see, generally if you put a what? Annuity factor, right? Normally when it is starting, have a look. If you get the, now see, if I tell you that I am giving you cash flows for 5 years, okay? 1, 2, 3, 4, 5 years, I am giving you same amount. Discounting rate is given to you, correct? Or discounting rate is not given. Cash flow is given, initial investment is given, right? So at NPV is equal to 0, initial investment is equal to what? Your present value of future cash flows. If this is the situation, right? And you have to find what? Tell me the IRR of the project. In that case, you have to do initial investment divided by the even cash flow that is there, right? And get a annuity factor, right? With that annuity factor or whatever factor you get, go into the, so how many years is the cash flow, you have to look at it, right? And in that row of fourth or fifth year, you have to go and find where this factor is closest to. Let's say it is between 6th and 7th, right? Get the difference between both of them. Wherever the difference percentage is lower, select that option as your IRR factor with an annuity cash flow given, right? So I've made a small formula and I've done 2-3 questions of it, right? Then comes perpetuity. Perpetuity is also 3 or 4 types or 5 types of perpetual. Perpetuity ka formula is there. Basic perpetuity starting from year one. Perpetuity starting later, right? Starting later means what? Tell me. It is basically starting from second year or so. Then perpetuity starting now or 0 year. And then perpetuity with growth and perpetuity and IRR, right? So perpetuity starting from year one, perpetuity is nothing but the cash flow repeating for n number of years. Correct or not? Repeating for almost up to perpetuity, right? So that is how it will be. Then perpetuity starting later. Later means what? Tell me. It will start from second year. So when you have to find a present value of a perpetuity starting now, that is from first year, right? Or from year one basic perpetuity, you do what? The perpetuity cash flow divided by the discounting rate percentage, right? Then perpetuity starting later, right? Later means what? It starts at a later time, correct or not? Not from year one, but year two or three, right? So what do? Wherever the perpetuity starting, you wait 1 year before the perpetuity starts. Take all the cash flow from next year, bring it to the year 1 year before perpetuity, and then take it to 0. So it will be this 30 divided by the 18% discounting factor, correct? And then what? The 18% second year discounting factor and bring it to 0 year. Correct. That is how you do PV of perpetuity starting later. Correct. Then there is PV of perpetuity starting now. How do you find that? So what do? You forget the 0 year perpetuity. Take first, second, third, fourth year or till perpetuity, bring it to 0 year, and then add the inflow of 30 year. So 30 divided by 15%, right? Whatever is the answer, and then add this 30 year, and it becomes 230 ka present value of all future cash flows. Correct. Then coming to perpetuity with growth, correct? Perpetuity with growth is I give you $100 first year and then it will grow. I will give you every year uska 5 or 10% growth, correct or not? So 30 I'm giving you, right? At the end of year one, then it will grow by every year. So this is perpetuity with growth. So what I will do, I will wait at 0 year, take the 30, that is first cash flow of the perpetuity, divided by the discounting rate 19% minus the growth rate of 5%, and $30 divided by 14%. And I will say what? Initial investment plus the PV of perpetuity with growth. Have a look, right? This you can then use the formula direct, right? Then going ahead, perpetuity plus IRR. The formula is nothing but IRR of perpetuity. If you have to find out, it is very simple. The even cash flow divided by the initial investment that is there, right? Have a look. Then full-fledged NPV. Now let's do one thing. 1 minute, I have some work. Give me just 15 minutes. You by the time either practice and can you have a look at this? Tell me. ये देखो, ये वाला part. Can you solve it? Try करते हैं. Practice. Here, 3-4 questions that are there. Try to solve these questions. Just give me 15 minutes. I'll be back in 15 minutes. By 4, we start. Just quickly join it. We'll start now. Okay. Now let's go to the full-fledged NPV part, right? You have the basic part, the prerequisites that you need to know. Now in this, quickly I'll also tell you what questions to solve, okay? So that you have a better understanding of things. The first is the quickly. The format we have to remember, correct? First, let's come to the format of NPV. Quickly join it. The format for NPV. Full-fledged NPV format, that is there. You have what? Particulars, amount in dollar. First thing that you have to decide is how many years is the project for. Generally, if the project is given for 4 years, right? You draw 5 years because you know the tax will be 1 year arrears given to you. Correct? Then the second decision you have to take is whether you have to take dollar, thousand or dollar million. Generally, this you have to decide on what? Based on the question that is given to you. Correct? So quickly, these two decisions. So heading you have to give calculation of NPV. Then you will say sales minus variable cost gives you contribution. Contribution minus fixed cost and minus the other costs, right? Will give you net operating cash flow before tax. Then you deduct tax at dash dash percent on net operating cash flow. Then you have the initial investment, scrap value, and the TS on TAD. And last but not the least, working capital invest, right? And then you have the discounting factor that is given, right? And then you have the discounted cash flow, that is present value of the cash flow, and the NPV that is there. This is the destination. Generally, you make working note for sales, variable cost, fixed cost, your TS on TAD, and working note. So generally, 4 or 5 working notes are there. So have a look, and also the cash flows that you consider in this NP project are going to be all relevant cash flows. Correct or not? Have a look at relevant cash flows. Relevant cash flows are basically the future cash flows that are going to be incurred, cash-based expenses that are going to be there, opportunity costs that are going to be there, and cash flows that occur when project is carried out. Irrelevant cash flows have nothing but non-cash expenses, depreciation, amortization, provisions, allocated cost, your depreciation costs which are or departmental costs, sorry, not the depreciation, departmental costs which are allocated historic or some cost, right? And then your committed costs that are there, factory rent and all those things which will be incurred even if you take the decision or do not take the decision. Interest cost will not be included because what? Tell me. Right? So interest cost already included in discounting rate, hence it will what? Not be included, and cost already incurred, right? Will not be again included. So now coming to next part of what? Your inflation. Inflation has two methods. I'll come back to the query that has been asked, right? Inflation has two methods, correct? Single rate inflation method, where real cash flow multiplying by the inflation factor 1 plus the inflation rate raised to n will give you the nominal or money cash flow, and real discounting rate when multiplied with the help of what Fisher formula 1 plus real rate into 1 plus inflation rate gives you 1 plus nominal rate, correct or not? Right? So you can get the nominal discounting rate, then real cash flow discounted, right? Will give at real cash flow. If you are discounting, then discounting at real discounting rate. But when the cash flows are nominal, then you will discount at nominal discounting rate, right? If there is a single inflation, right, for cash flow and discounting rate both, then real NPV should be equal to nominal NPV. And I proved this in class, and I do it always, every time, correct or not? Then nominal cash flows, if you want to deflate, right, you should divide by the deflation factor, because when you're inflating, you multiply. So deflate means you are going to remove the effect of inflation, correct? So divide by the deflation factor gives you real cash flow. Nominal discounting rate, correct? If you want to go to real discounting rate, Fisher effect formula you can use. And nominal NPV generally is equal to real NPV when cash flow and discounting rate both have only same inflation rate which affects cash flow as well as discounting. Correct? Then specific inflation rate method or multiple inflation rate method. Sales, variable cost, fixed cost, and other cost. General inflation rate, right? So for sales, selling price inflation will be given, variable cost inflation will be given, correct? Fixed cost and other cost, fixed cost inflation will be given, correct? And for your discounting rate, you will use the general inflation rate, correct or not? Have a look, right? Your old real cash flows, you will increase by the nominal cash flow, correct? Or by the inflation rate, get the nominal cash flow, do the nominal discounting rate. Now see that one question of Pink's company, right, is important question that is there. Pink's company, you can try it, right? So what all questions you can do from NPV? Now see what I will do is today we can do the full revision, correct? The faster we complete the revision, better it is for you. More time you have to solve questions. I'll try to do it as fast as possible and I will mark important questions, right? Do all those questions up till tomorrow afternoon by the time you have the class. So what will happen? All those NPV questions will be done and you will be ready for NPV and working capital management, right? Cash flow and timing of inflation. Aa jao zara, right? Here, if you are now see, here I know that one part of Pink's company has a deflation part, but that is not that important because when Pink's company question was asked, at that time a technical article came on the same, and according to that, things were done, right? So cash flow and timing of inflation. Cash flow and timing of inflation means what? Now see, at times what happens? One single rate is given of today, and inflation applies from first year. In some questions, first year terms everything is given, and inflation applies from second. So current terms and inflation applies from first year. 1 year terms, inflation will apply from second. Correct or not? Have a look. Right? Then this is how it is. Right? So if a lot of you ask me, sir, if nothing said whether to find nominal NPV or real NPV, the base is nominal NPV. If the question specifically tells you to calculate real NPV, then only do real NPV. But nothing given, your nominal approach is always preferred because if inflation rates and everything is given, then it will have the same effect. Now see, when you say about tax, right? So tax paid in the same year in which income is earned, then this is the net operating cash flow. On this only tax will be paid in the same year, correct? And same year if it is in arrears, right? Then tax payment will be arrears, right? There is not a loss, but if there are losses, correct? Losses, that means net operating cash flow is negative, correct? In that case, what will happen? If nothing is given and in the question, you can carry forward the loss ahead to next year and it can be carried forward indefinitely. No tension. That means you use it in next year. But if the question says that losses of one business can be used by existing business, then take tax savings, correct or not? That means instead of paying tax, you do positive what? So here I in the Excel sheet, if you have a look, corporation tax. I have done both the ways in which question can be done. Have a look. Normal corporate tax question. Have a look here. Losses and tax payment. Have a look. So here there is a loss, correct? So if let's say that nothing is given in the question, then this loss will be carried forward to next year and new net operating cash flow will be calculated and corporation tax on that will be calculated. But if right, see that 1 year ahead, that is okay. But if rarest of the rare question where it is said that company, existing company can absorb the losses, in this case is minus 14149.5. This will be tax savings because of the losses. Correct? I don't know, not a lot of books has this, so you can have a look at this. My challenge that out of this, it is very difficult for anything else to come up. Correct? Then comes what? Tell me. Initial investment and scrap value. At times, initial investment is given in 0 year or 0 year and first year both, right? Scrap value could be inflow. Generally, scrap value is inflow in last year of the project, right? But at times I've seen it being also outflow, decommissioning cost or something like this, right? Then TS on TAD. TS on TAD, timing of TS on TAD. Someone asked a doubt that if tax is paid in arrears, so if it is paid in arrears, savings will also happen in arrears, right? So if there is a first year cash flow on which tax is paid in the same year, then TS on TAD also will be in the same year. But if it happens in next year, then tax will also be paid in the next year and saved also in the next year, correct? Then sale of asset in the last year of the project, correct? If opening WDV of last year is greater than scrap value, opening WDV is less than. In this last year, if there is a loss, it will simply be balancing allowance, right? That means opening balance of last year and scrap value difference. If it is loss, then it is balancing allowance, right? And it will what? It will save tax. But if it is profit, then you will have to pay extra tax. I must have done something here. TS on TAD. Now see, TS on TAD also has three methods actually, right? WDV basis, SLM basis, SLM basis on a percentage, correct? And 100% depreciation immediately available, right? So the three methods, most of the books do not have all the three or four method that is there. Balancing charge and balancing allowance, I don't think there is a lot of problem. Now see, 8437 is the opening WDV. The scrap value is full loss of 8437, and on that tax will be saved here. I will if paid in next year, if paid in same year. Here I don't have a problem. I have problem here. I will. Now have a look. What is happening? The life of the asset is 10 years and project life is only 4 years. So you will only take tax for what? 4 years only. Tax shield in the project. Maybe 10 years stuck, the calculation can be done, but project life is only 4 years. You will take TS on TAD only for 4 years. Because in the exam, these kind of questions only come up, correct? Then, fifth one, SLM basis. SLM basis means what? Useful life given, you have to use the SLM basis formula, right? And find the depreciation every year. Last year also, and factor in the scrap value as well, so that depreciation will be same every year. But when it is what your here SLM method of SLM as a percentage. Method of depreciation SLM at 20% means what? On the initial investment, 20% every year will be paid, right? Right. This is something that you have to see. This is not available in a lot of books, but this is there probably in AFM. So I have taken because the examiner likes to pick up questions from AFM and put it in FM. I teach AFM also, so I know, correct? We have what an AFM batch also going on. So morning their revision was going on. After that 3 p.m. your revision is going on, correct? Then 100% depreciation available immediate. In this, what will happen? Same 0 year, but depreciation even if today asset is taken, right? Depreciation will be available at the end of first year, and tax savings will happen if same year in the first year, and if next year it will happen in the second year. I will. There you go. But if there is scrap value, rarest of the rare question, right? I have never seen this question where 100% what depreciation is there, and at the end what? Tell me. This is given at the end scrap value, which is nothing but the profit that is there. जिसके ऊपर tax pay होगा, because you have claimed full amount as depreciation. Correct or not? Have a look. Right? That is how it is. See? Sure. Then can I go ahead? Sale of asset in last year of the project. उसके बाद working capital investment. Working capital investment generally as a percentage of sale. Correct? Basic, advance, both are there, right? So basic and advance working capital given today and then increasing by the inflation rate. Working capital investment. So generally that is there. If nothing given in working capital, it is assumed that working capital is repaid back or remitted back at the end of the project. If nothing given in the question, right? Generally, working capital will be repaid back, right? So it is generally given as a percentage of sales. So what do you do? 150 to 600. The sale into 15%, correct or not, is the rate that is given. So every year at the start of the year, generally. So first year ka sale at the start of the year, because without working capital, you cannot start a business at all. Correct or not? Have a look, right? Then you do what? I got this working capital investment. Have a look. Dekho. But first I have to calculate balances. First I will do this into 15%. These are the balances. And then I will find the difference. Difference means what? If sale increases, more investment will be required. If sale decreases, right? Investment release or release of investment will happen. And at the end, the full reinvestment up to year, right, has to be what? Released. So year up till year 32,400 is the working capital investment. I get it back in the last year. So negative, whatever I invested, I'm getting back the money. So if you want to check this kind of question in exam, the total of this should be equal to 0. Correct? That is how it is. Correct? Working capital investment. 2-3 ways of doing it. Opening closing balance also, right? If it is not repaid back or something of that sort, then it will remain invested only. Correct? We will not repaid back, right? Then working capital is a percentage of sales. You can have a. I don't think that AFM part is that much important, right? But first year given and later on it grow by the inflation rate. First year 5,000, it grows by the inflation rate. They will give the inflation rate, right? And then at the end, whether it is remitted back, then get back the money. Not remitted back, put it 0, go ahead. Every year it will grow by the inflation percentage. फिर repayment happens. ठीक है. At times balance is given to you and you are told to find working capital invest. That is also okay. Correct. Then working capital investment given direct. These are the 3-4 methods by which working capital comes in. Correct. Then cost of capital or discounting rate. Generally, nominal rate of discounting, obviously, because you are going to use nominal cash flows, that is inflated cash flows, is specifically given to find real NPV, use real discounting rate. If direct WCC or weighted average not given, then you have to use the weighted average formula V divided by V plus VD into K plus VD divided by V plus VD into KD 1 minus tax rate. You have to use this formula, correct? I have given the explanation of how to find KD and KD, everything here. But later on in the portion, it happens. Now have a look what are questions. First question that you need to solve is Pink's company, correct? Pink's company question, right? Write down the names of the section C question that you could solve. Not here. Write down the important questions that are there, at least from NPV point of view. What are the important questions? Investment appraisal में you have to do Pink's company, correct? Pink's company for investment appraisal. OKM company, Duo company, OKM, Duo you can do. Duo, Ajay, जरा एक minute. Duo is based on what? Sales versus demand versus capacity, right? So whenever you have sales, there are 3 different things. Sales means how much is the actual sales that happen, how much is the demand, and how much is the capacity, correct? All 3 of them, whichever is lower. So if you have what? Demand of 10,000, but you have capacity only of 5,000, right? Your sales will only be 5,000 because you cannot make more than 5,000, correct? Right? That is how it is, correct? So have a look at it, right? Duo company, a lot of students don't understand it until the end. OKM company, you can do OKM company, right? OKM हो गया. Then you could do Pinks to I gave you, no?
Yes.
Spinks Duo related Degnis company. I think it is not there in the book, but it was there in the old book. Degnis company, correct? Degnis company. Degnis company is a good question, right? Genie company recently that has come up. Genie company, correct? I will come to capital ration. Right now, I'm only giving NPV question. Okay, I know, right? So at times sales, selling price, variable cost, and fixed cost given probability. Sometimes probability given, sometimes fixed cost in total given. Then sometimes BRT company there is a range that how much is the sales or how much is the demand. Accordingly, selling price will be decided, variable cost will be decided, fixed cost will be decided. Correct? Okay. Then sales versus demand. Okay, existing capacity. So always whenever you are taking a decision, always take a decision for new asset that you are taking and don't take it for or don't consider the existing part that is there. And also fixed cost. There is a question called as Charm Inc. Charm Inc. says that if there is a sales that is happening at the start, very high sales, and it is falling gradually, the fixed cost that is set at the first year will be the same for all the 4 years. Correct? Go through this question, Charming and BRT company. BRT company is also a good question. Correct? You can have a look. Correct? Then Charming, okay. Then there is a question called as Melplash company. Melplash. Melplash company. Melplash. First time ROC, payback period, NPV, IRR, all four were asking a question. Melplash. Right? So with this, I think your basic NPV, right? And your investment appraisal part is done. These are the questions you need to solve from there. Okay?
Sir, after Charmy company, what you say, sir?
Sorry?
After Charmy company, what company you say? Reddy company.
The BRT company and Charming. Melplash. Genie company. Genie. Gini. Gini.
Okay.
Correct? एक Elan company is also there. No. That. See, by my method, if you do it, correct? Right? The ROC wala part, right? ROC, right? You should logically look at ROC from a different perspective. Don't look at Melplash company. Use my method. Okay. Elan company also you can do, right?
I was asking for Melplash itself because in Melplash for ROC they have done that.
One is wrong. Wrong as in the wrong method. The method that I have used, correct? That is better. Take the net operating cash flow, deduct depreciation from it, right? Get the PBIT, get the average PBIT, correct? And then divide it by the initial investment or the average investment. Don't go by their method, what solution they have given. I know. We had a very long discussion. Hey,
And even if we have a different, even if we get a different answer, we'll get marks for that.
Different answer, idea nahi, the answer is same. You want to see either Melplash we have done. We had a very long discussion in the main class also. But at the end, when we calculated it, I think here Radhika madam. Have a look. Net operating cash flow ko leke we have done payback period. Net operating cash flow. Here Radhika. The average PBIT calculation. Net operating cash flow. Depreciation on SLM basis added. Right. I got ROC 20.37%. That is the only answer. Right. Same answer we get by my method or any method that you do.
Okay,
Take
sir.
it.
Thank you. And sir, there was one more doubt. There was a question in practice mock 2, and in that the tax was charged in arrears, but the tax saving was done in the start of the year, which means if we are
So we have done that question. NPV also be matched.
oh no, because then the tax saved on TAD should have
Answer
been
नहीं
charged
है.
in year 1, right?
Answer में printing problem would have been there. We did the mock debrief. Recent mock, no?
Yes, sir. Practice exam 2.
We did the mock. No problem. Should not be a big problem. Arrears, it will always be in arrears, right? It is given by ACCA, correct? So maybe, I don't know which question you are talking about, but if it is from mock 1, we have already solved mock 1. Okay.
So can I send you the question on the group?
Yeah, send it, no problem, right? Now see, for those who want to practice difficult questions, I have tried to put up all the difficult questions here. You could go through these questions and solve it. Okay. The practice that I have taken, right? Then come to the copper company now, madam. I have not yet gone to that portion, right? Come to what? Investment appraisal under uncertainty, correct? So risk versus uncertainty. Risk is what? Tell me. Basically, risk versus uncertainty, right? So risk is a situation where you have various possible outcomes and you can attach probability to the what outcomes and get the expected value. But when it is uncertainty, uncertainty also has various possible outcomes available, but you cannot attach probability to the same, correct? Have a look. Right? So have a look, but you cannot attach probability to it. Then mathematical models can be used to quantify risk. But here, I'm telling you right now only, okay, that this part of risk versus uncertainty has come up so many times in exam, right? That the same question only the examiner will ask. At times they have asked it for 6 marks also. So don't take it lightly. Has been asked for 6 marks and very simple definitions that are there. Then comes the part of sensitivity analysis. Generally, sensitivity analysis is what? The NPV that you get divided by sum of present value of the variable after tax, right? Selling price, variable cost, contribution, sales volume, fixed cost, initial investment, etc. Right? So that is how it is. Assessment of risk. But section A में assessment of risk में the details have to be given, right? Oh.
No, sir. If they ask that choose from two, they give 4-5 options. Then they'll say that which of the mathematical models you can use in risk assessment. So then they don't give importance to sensitivity analysis. But when in section C they ask, they expect us to include sensitivity.
Sensitivity तो हमेशा one of the methods of what risk assessment.
Sir, 2-3 questions I solved. They give me I didn't get the marks for it.
No problem. If other question you could what do it as what mark it as important or different question and go ahead with it, correct? Then simulation is what?
Okay,
Sensitivity. So sensitivity analysis, always remember when it asks for contribution or sales volume, it will be one and the same thing, correct? Sensitivity of contribution is also called as sales volume ka sensitivity, correct? So sensitivity of sales after tax is nothing but the sensitivity of selling price falling, right? Then which makes the NPV go to 0, correct? So wherever positive cash flows has to fall, percentage fall. Negative cash flows, the variable cost or something has to go up, right? Then you could have a look at the question that we have solved. Then simulation is nothing but what? One of the disadvantage of sensitivity. I am telling you, this is most important question. So many times simulation cut copy paste question has come up, right? So the cut copy paste question says simulation theory, that is their sensitivity analysis has a disadvantage that it measures the change in present value of a single variable to NPV, correct? But simulations help you what? Analyze the change in multiple variables. One variable changing sensitivity, multiple variable changing simulation, correct? It is difficult to calculate because it is a computer-aided technique and a lot of different simulations are run, correct? And it is a considers what different variable changing and various possible outcomes. 4 steps of simulation. Big 6 marker, if it comes for simulation, you have to write 4 steps as well. Correct? So you have to first identify or define the variables that are there, that is sales, variable cost, fixed cost, initial investment, scrap value, TS1, TD tax, etc. Right? Then specify or define the relationship between the variables. Right? That sales minus variable cost is contribution minus fixed cost is net operating cash flow and so on. Simulate the environment. Right? Provide the input or change in different variables. So your sales might change 5%, this might change 10%, that might change 15%, right? And get the possible outcomes. Then to these outcomes, what? Attach probability and get an expected value is the final result of simulation. Has been asked so many times, can be asked again as well, correct or not? Then coming to the question of probability analysis. Generally, probability analysis if asked in section A and B are generally what? Your basic probability question, right? So NPV of a project is given and probability is given. Then you would do what? Find the expected NPV of each project. Choose the project with what? Max NPV, correct? Then 1 year project plus probability of discounted cash flow. Always remember, if DCF is given or cash flow is given. If cash flow is given, then you first have to find the expected cash flow, then discount it and compare it with the initial investment and scrap value and find your answer of NPV, expected NPV. But if direct discounted cash flow given, then you have to find the expected discounted cash flow. Then what? Tell me. Get the NPV. You won't have to discount it again because it is already discounted cash flow, correct? More than 1 year, generally an annuity cash flow is given. So cash flow plus annuity. So probability of what? The same cash flow repeating, right? Or the same cash flow is given and plus that is given 1 year ka, where basic probabilities are. But when there is joint probability, not one but more than 1 year ka project will be there. Correct? First is one way of doing it is directly doing it without joint probability table. Correct? And one way is doing it without joint probability table. Without joint probability table, directly you can do what? Find expected cash flow of each year and what? Basically do the discounting and find the answer, right? But when it says joint probability table, first you will have to make a joint probability table where you will say in first year how many options or outcomes are there, second year how many outcomes are there. If it is a 2 and 2 ka, what 2 options here, 2 options here, then there will be 4 probable outcomes. Then if there are 3 options here and 3 options here, 3 into 3, 9 possible outcomes. So 3 by 3 matrix or 2 by 3 matrix you will have to take out. Then joint probability may take all the outcomes, correct? So that copper company sum that we've talked about, correct, is the same question. Yes, it can come in section C, has come before and will come in the future, correct or not? Right? So at times one question was there in one of the books. Now see whether copper company, so we have solved here. Have a look, copper company. Have a look at copper company, right? But in one of the questions now in copper company, if you have a look, cash flows are given, right? But at times, right, in the examination, read whether cash flows are given or DCF is given. If DCF is given, then you don't need to do this. Here I have done what? Discounting of the cash flows. Have a look. Right? You don't need to do this discounting. Those are directly discounted cash flows. And then the follow-up questions are what? Tell me. The follow-up question is what? Probability of having positive NPV, probability of having negative NPV, probability of having zero NPV, probability of having maybe what? More than 10 ka NPV, 20 ka NPV. Those follow-up question of 1 mark will go wrong if you do not do this properly. बराबर है क्या? देख लो जरा. Have a look. Makes sense. Has been asked too many times. Okay, don't miss out on copper company at all. In your wildest of the dreams also don't leave what? Joint probability. Very simple marks, right? Simple calculation, simple marks. Then going ahead, right? From here, I must have given homework. Have a look. We've done joint probability table by hand also. And homework question, instead of copper company having cash flow, if they are given discounted cash flow, then you do not need to do discounting again. So that is something that you need to work out on. Asset replacement decision. Asset replacement decision may you have lease versus buy, correct? Then you have the practical part, EAC and the capital rationing. EAC or EAB. Lease versus buy is very simple, correct? The cash flows, relevant cash flows for lease versus buy, right? In lease, basically you have taken the asset on lease, and in buy option, you are going to borrow and buy the asset, correct? So generally your purchase price of the machine or asset is a relevant cash flow, tax shield on tax allowable depreciation is a relevant cash flow because you are going to be the owner. Maintenance cost, if nothing is given in the question, the owner bears the maintenance cost generally. Lease may maintenance cost cannot come, but if default assumption is maintenance cost will be taken care by the owner, if nothing given. But if specifically given that the lessee takes care of the maintenance cost, then maintenance cost will be there in the lessee's column, correct? But generally 99.99% borrow and buy my maintenance cost will come up. Tax shield on maintenance cost will come up. Even if it is not said that maintenance cost is tax deductible, but maintenance cost is allowed as a deduction from P&L, and hence by default TS on maintenance cost will come. Then government tax on asset, road fund license, test for efficiency. All these things which are not generally debited to the P&L, but are given that tax saving due to this expense will be done. Tax shield should be taken on that amount, correct? And then at the end, scrap. Lessee has two basic cash flows: lease premium paid and tax shield on lease premium paid, right? Rarest of the rare, I told you, maintenance cost could be borne by the lessee, right? If it is given in the question. If nothing is given, then no tension. And one more thing that is important, one of the most important working note, correct? Right? You have to compare between lease and borrow and buy. So when you borrow, the cost of borrowing after tax will be used to discount the cash flows between lease versus buy, because they both have to be compared, right? So how to get the KD before tax to KD after tax, how to go? See, if tax is not given, right, then use KD before tax. But if tax is given, you use KD after tax to discount the cash flows of lease versus buy, correct? Now generally lease premium and uska timing is something that is what important. So somewhere if it is said that what 45,000 is the lease premium will be paid in what advance. In advance means what? First year in advance means 0 year. Advance means what? The start of the year, correct? But tax is paid in the same year, then tax comes in first year, correct or not? But tax paid in next year, then 0 year mein lease premium will be paid, but tax will be saved in second year. This is something that you have to look at, correct or not? Then, but lease premium is paid at the end of the year and tax is paid in the same year, they both are in the same year. This is so normal, this happens before as well, correct? Have a look. These are the 4 options of lease premium and the timing of lease premium. Then what you have to do? Get all the details or get all the net cash flows or net cost of borrowing. Try to find the present value of it using the KD after tax if tax is given, KD before tax if tax is not given, right? Take the lease premium and tax shield on lease rental, correct? And then basically take the total of that net cost of leasing and then find the present value of it. Wherever the costs are lower, I will choose that part first, correct or not? Or I will prefer borrow and buy over what? Easy. Then equivalent annual cost. What is equivalent annual cost? Right? You have the what? 2 machines which you need to, or 1 machine which you need to what? Replace. Either it should be via what? Tell me. Either it should be replaced every 2 years or either it should be replaced every 3 years. Every 2 years or every 3 years. So every 2 years and every 3 years all the cash flow will be given, right? The same relevant cash flow that you have for buy and borrow will apply here, correct? Right? So 3 or 4 year project, right? You have to what? Tell me. Both cash flows you have to list one below the other. Therefore, I have done here. Replace the tax with type a truck 3 years, right? So 3 years from maintenance cost, scrap value, everything I have given, right? 3 years or 4 years. Barabar. You do this, then find the present value at the discounting rate. Then use the EAC formula. The EAC formula is something like this. What is the EAC formula? Sum of present value जो आपने निकाला है divided by the annuity factor, considering that it happens every year, right? And then if you replace it continuously, it will be replaced, and you get a equivalent cost of every year in both the situations, 3 year and 4 year. Wherever you have the least cost or lower cost, you have to choose that option. Correct or not? Have a look. I have given all the different options that can come up. Right? There you go. Here generally in lease versus buy you use what? The WAC in lease versus buy you use KD rate. Here you use cost of capital, that is WACC rate. Correct? That is how equivalent annual cost works out. Generally, a lot of times EAC or what has been asked, or lease versus buy in EAC has been asked in a lot of different types. Before tax, they are told that ignore taxation. So accordingly, you look at the question and then do what? So if you ignore taxation and cash flows are before tax, then you can use the before tax rate. Correct? Right. So have a look. Then in capital rationing, there is a theory question and a practical question. Correct? Theory question. Now for this EAC, important question. Correct? A Hawker company, I think, is a EAC question. Jitna I remember, Hawker company. No, Hawker company is lease versus buy. Important question. Right? Cabrera's company for EAC. Hawker and Cabrera's. Hawker. And Crockett company for capital rationing. Crockett company. Crockett company for capital rationing. Correct? Hello? Right? So now come to the last part of investment appraisal, is your capital rationing. Correct? The theory and practical both are there. Theory says that most important is theory. Capital rationing theory has been asked in, I think, 5-7 attempts, 2-3 times it is asked, 50% times. Capital rationing, types of capital rationing has been asked. First, you write the definition of, basic definition of capital rationing, right? It is what? When you have multiple positive NPV projects, but your capital is rationed or you have low capital, that is there, and you cannot invest in all projects due to the capital constraint. So there is a capital constraint that is there, and there are 3 or 4 types, right, of what? Capital rationing theory. Others are types of capital rationing theory. You have what? Your types or reasons of capital rationing, right? You have hard capital rationing and soft capital rationing. Hard capital rationing is what? External capital rationing. And soft capital rationing is what? Internal capital rationing. Both these words also could be used interchangeably. Correct? That means hard or external and soft or internal. Hard capital rationing means what? Tell me. Right? Company has to restrict the capital because the capital cannot be sourced externally. Correct or not? So you are not getting money from outside because of outside what? Environment, right? So it is hard capital is externally, right? Then company has to restrict the capital because the capital cannot be sourced externally, right? What is the reason for hard capital rationing? Correct. It is your low credit rating of the company or limited security for loan. You don't have a security or shortage of security for loan. Economic factors like recession are present in the economy. Industry-wide limiting of funds. Generally for your industry, funds are limited. Poor history repayment or history of repayment of loan may make banks not lend to company. Correct or not? Internal what? Tell me. Soft capital, internal capital rationing or soft capital, where company itself imposes what? Restrictions internally, right? The reasons for it is that department may be given limited resources to encourage internally 2-3 departments के बीच में you want what? Competition. Risk attitude of directors is on the lower risk option. Poor management skills to handle the variety of projects. New equity for investment may lead to dilution of control of existing shareholder and desire of getting maximum return from available capital. Right? And then you have single period capital rationing, multi-period. Single period is basically in one period only you have capital rationing. Multi-period capital rationing is solved by linear programming problem and simultaneous equations are made. But this is in AFM. Correct? So no tension there. Now coming to what single period capital rationing. You have 4 types of questions that can come up in exam. All projects are independent and divisible. All projects are independent, right, and indivisible. Certain projects are mutually exclusive, remaining are independent, and all projects are divisible. Certain projects are mutually exclusive, certain remaining are independent, and all projects are indivisible. Now, don't be surprised. This is not there in a lot of books. Don't be surprised if this comes in the exam. So, first is what? If all are independent and all are divisible, in that case, use the PI method. Correct? PI is nothing but NPV divided by initial investment. You find the profitability index, rank the projects, right? Allocate maximum at the highest ranks, and keeping in mind the capital constraint, and get the max NPV. If there is a tie in NPV or PI percentage, choose project with lower initial investment, right? Tie in initial investment, choose project with higher NPV. Correct? Because there are a lot of times in ranking ties come up. Tie means what? Same things. Either initial investment is same, either NPV is same, either what? PI percentage is same. So accordingly you decide based on that. Now when it comes to what? Tell me. All projects are independent and what? Tell me. Indivisible. If they are indivisible, that means, see, your indivisibility part of the project can be done. Indivisible means what part of the project cannot be done. In that case, by trial and error method, you make groups of projects. Correct? Keeping in mind the capital constraint, that means cannot go above. You can have slack or some part remaining, where you have not yet what invested. Correct? Then tie in initial investment. Choose higher NPV project. Correct or not? If you have initial investment same, choose the project or choose the group of project which gives you higher NPV. Correct? Choose project with max NPV and lowest initial investment. Then comes the part of what? Certain projects are mutually exclusive. What are mutually exclusive projects? Mutually exclusive projects are very simple and straightforward. If you do one project, right, you cannot do the other project if they are mutually exclusive. That means maybe the labor or material required is same, and only one project can run at a time. Two projects cannot run together, right? And if that is the case, certain are mutually exclusive, certain are independent, and all are divisible. Correct? So in that case, you will use PI method, do the ranking, right? But while doing the allocation, right, you will keep in mind that once you have allocated to one mutually exclusive project, the second mutually exclusive project cannot run. This question, third question type, is nothing but your what? Crockett Company. Important question. Crockett Company. Crockett Company has been asked in exam, can be asked in exam. My what? Prediction says this time either this third or this fourth. I don't know. I have a very strong feeling. Capital rationing question is loading in the exam, where either last May, fourth wala, mutually exclusive projects. Correct. I have already done practice here. Practice we have not done in class. We do it in Excel again. These questions for practice you can try. But we did not know capital rationing question. Either here, right? Some projects are independent, some are mutually exclusive, and all are indivisible. I have done all the questions. You can have a look at every question that is there. All 4 types, and good questions I have taken in class. So you can have a look at those, try to solve them, right? Have a look, right? This practice I have done after every part, where you can practice these questions and try to understand them, right? Sure. उसके बाद वर्किंग कैपिटल मैनेजमेंट, basic निपटा लेते हैं, then I'll give you a short break. Correct. चले. So I've marked all the important questions as well. Okay. So these many questions also from today till tomorrow, if you do more than enough, right? As in section C के लिए A and B you have already done, right? With the notes you can sit and solve A and B question as well, correct? Then working capital management, right? So working capital management basics में you have 4 or 5 things, right? You have the working capital ratio, correct? The working capital ratios, activity ratios that are there. Then you have the cash operating cycle, liquidity ratios, current and quick ratio, working capital investment strategies, working capital financing strategies, and the over trading. Now come to the part of working capital ratios. There are 2 types of working capital ratios. If I'm not wrong, this time's mock paper, correct, has working capital ratio for what? Tell me. Manufacturer as well. There are 2 types of cash operating cycles or working capital ratios. Cash operating cycle of a trader, which is nothing but account receivable plus inventory holding minus the account payable, gives you cash operating cycle for a trader. But when it comes to cash operating cycle, right, and the inventory holding period formula is average inventory held divided by COGS into 365 or 12 or 52 depending on what is asked in the question. It could be COGS or cost of sales. Cost of sales or COGS is nothing but what? Tell me. All the sales minus the direct cost, correct? So gross profit wala part, direct and indirect both costs will come actually, correct? So all the costs will come. Then account receivable period is your average account receivable period divided by the credit sales, and account payable period is your average account payable period divided by credit purchase or COGS or cost of sales that are given, correct or not? Have a look. We have derived all the formulas, correct? Then there are turnover का formula, section A and B में very famous. Turnover formulas पे question being asked, correct? Inventory holding turnover period is nothing but the COGS. You do the complementary ratios. COGS are cost of sales divided by average inventory held. Here there is a note, correct? If in a question average inventory is given and opening and closing, or rather closing inventory is given, right? You would recommend or you would take first preference to average inventory rather than taking closing inventory, correct? Then account receivable turnover is nothing but credit sales divided by average account receivable, correct? I'll give you. No, don't worry. Right? So credit sales divided by average account receivable into dash or what? Times. Correct? Gives you the answer in times. Through this, cash operating cycle is asked. I have taken 1 or 2 questions here below. Right? These were there in the study hub also. Recently study hub made these questions have been added. Then account payable turnover ratio is nothing but credit purchase of COGS by average account receivable. Gives you answer in times. Correct or not? Then of manufacturer. This C, positive working capital cycle is something where cash inflow is slower, cash outflow are faster, shortage of cash. Negative working capital cycle is what? Tell me where cash inflow is fast, outflow is slower, extra cash in hand. Correct? Ideal position every company wants to be in. This is not there in a lot of books. What turnover में क्या problem?
Sir, in section A, section B, there are some questions where they have taken the turnover formula as the reciprocal. But there are some questions in which they have not taken the turnover as a reciprocal.
So उसका क्या लेना देना?
नहीं, मतलब if you are taking turnover, so then
So
we
if
need
it
to.
says turnover period, then it has to be number of days only. But if it only says in times, then it has to be the reciprocal formula, logically.
Oh,
It is the wording that is there, correct? Then उसके बाद last we'll do and we'll take a break, correct? Then your cash operating cycle for a manufacturer was asked. Now see, these time ka mocks you should take very seriously, because mock के same questions appear or similar type of questions appear in exam. So please go through the mock once before going to exam. Then cost of capital for manufacturing, correct? Raw material holding plus WIP period plus finished goods period plus account receivable period minus account payable period. Raw material holding is average raw material held divided by the raw material consumed into 365. WIP would be average WIP divided by total production cost. Finished goods already we have done. What average finished goods by your what? Tell me. COGS or COS. Wherever COGS or total production cost not given, there you can use in WIP COGS or COS as well. Account receivable and account payable, already we have discussed the formulas, right? So instead of 365 or what 52, if they say 360 or 50, please follow that, right? If nothing is given in question, 365 and what 52, right? So after this, we'll continue, right? Take let's say 17, 515 तक आ जाओ. If you want to do practice, you can do practice, no problem. 2-3 question papers you can solve. Okay. Take a break, come back by 5:15. Okay. Sure. Quickly come back so we can complete before time. Aja. Working capital, right? So you can do this discussion, have a reading of this, right? Correct. So liquidity versus profitability. I have discussed this quite in detail. This is discussion part, right? At every chapter, account receivable very high is not preferable, very low is also not preferable, right? Because if you keep it very high, then profitability will have an impact, liquidity will have an impact, correct? So accordingly, you what decide that. A theory question on this comes up, right? That about what? Tell me. Balance of liquidity and profitability. So वो वाला part you will have to look at, correct? Pure discussion part, right? For all the 4 or 5 components that are there of the working capital. Then coming to the liquidity ratios, 2 liquidity ratios, current ratio, quick ratio. Now, logically speaking, current ratio denotes how liquidity position is in the company, right? Whether company can cover what the current liabilities or the current assets can cover the current liabilities, and if so, how many times, correct? Generally, more than 1 or more than 2 is recommended, correct? But it depends from industry to industry because the benchmark of industry is more important than what more being more than 1. Or quick ratio, for current ratio, the formula is current asset divided by current liability. In this you will take full current assets, inventory, cash, and account receivable, and current liability will be account payable and OD. But quick ratio or acid test ratio is far more better, where slow moving inventory or inventory is deducted to current asset minus the inventory divided by the current liability that is there, right? Here also you will have a lot of questions, right? Where current ratio is given to you, then they will say that some sale of inventory will happen, correct? Something of that sort, and then accordingly, what calculate the change in what? Tell me the current ratio. Those kind of questions are A or B में थोड़ा बहुत important as per the examination. Sales by, but when it comes to net working capital में you will only do what? Account receivable plus inventory minus account payable. Sales by net working capital. Have a look. How many times can you churn out sales with the working capital investment? So working capital, your net working capital would be what? Tell me. Account receivable plus inventory minus account payable. Then working capital investment, you have most important theory questions. 2 most important, working capital investment and working capital financing. I can't even tell you how many times these have been asked in the exam. बराबर है क्या? I think कितने बार? Out of 10 or 12 exams, 10 exams, 6 or 7 times working capital investment or working capital financing. Working capital investment talks about the quantum of investment in working capital, that how much amount is invested in working capital. There are 2 types of working capital investment strategy, conservative and aggressive. Conservative working capital strategy says that a high amount is invested into working capital. You don't have to worry about too much about what? Shortage of anything, correct? Account receivable is also high, inventory is also high, cash is also high. In that, what happens? More amount of what? Tell me. Your investment in account receivable and inventory, AR period will go up, inventory holding period will go up, your AP period will go down. Cost of cash operating cycle will go up. Current ratio, quick ratio, correct, will go up. Liquidity is more, correct or not? Because you have more cash with you. High investment, high borrowing, correct or not? Right? Therefore, interest cost is higher, profit is higher. Gearing के बारे में, right? When you do, generally your long-term borrowing is done, so gearing will go up, right? And here generally short term is then the gearing will go down. Sales by net working capital, right? Generally will go up, right? Or net working capital will go up. Sales by net working capital will go down actually, right? This is called as over capitalization or over investment in working capital. Aggressive working capital strategy, when a low amount of money is invested in working capital, right? Your account receivable will be low. That means you will not give a lot of credit period. You will keep inventory also low, and cash will also be low, but account payable will be high. Generally, the cash operating cycle will fall or remain the same, correct? Less amount of investment in what? Then your AR period, inventory holding period, AP period, all, or AR and inventory holding will go down, AP period will go up, cash operating cycle will go down, right? Then current ratio, quick ratio will go down. Liquidity is less, low investment, low borrowing. Correct. Interest cost is low, profit is more. Gearing will fall because generally you do short-term borrowing only. Correct. Or have no impact. Actually, gearing will have no impact. Correct. And sales by net working capital will go up because with limited working capital, you want to churn out more sales. Here, with more working capital, you churn out less sales. Comparison, right? And then under capitalization or under investment, right? Then coming to working capital financing strategy. Working capital financing strategy is nothing but based on what? Tell me. Generally based on from where will you raise the capital that you want to invest in? Working capital. So there are non-current assets which have a life of more than 12 months, right? Then there are current assets which have a life less than 12 months period, right? But in that there are two types of current assets, permanent current assets and fluctuating current assets. If a question comes up, please write all these definitions as well, correct? Permanent current assets are current assets which are present in business all the time, right? That is example, minimum cash balance, buffer cash, buffer inventory or minimum inventory safety stock, etc. Fluctuating current assets, right? Are current assets which fluctuate. So they keep on fluctuating all the time. Permanent current assets are permanently present in the business, generally buffer inventory or buffer cash, right? Then based on all these, right, you devise the working capital financing strategy. There is conservative strategy, matching strategy, aggressive strategy. Conservative strategy where non-current assets are sourced or financed through long-term sources in both or in all the three, generally at least in conservative and aggressive, non-current asset and fluctuating current asset by long-term, NCA by long-term, FCA by short-term. But when it comes to permanent current asset, if you fund it by long-term source, then what will happen? Conservative strategy. But if you fund it by short-term source, then it is what? Tell me. Aggressive, right? But every asset you knock the door and ask what is the period and accordingly you bring the loan or finance, then it is called as what? Balanced, correct? Or matching working capital strategy. Now, whenever you are using a conservative strategy, what will happen? You are using more long-term sources, correct? So interest on long-term sources will be high, profit will be low, gearing will be high because long-term sources and over-capitalization will be there. When it comes to aggressive working capital strategy, non-current asset, right? Or more risky strategy because you are using short-term sources for long-term assets, correct or not? Profit will be higher, but interest will be lower and gearing will be lower because you are using what? Tell me. Long-term or short-term sources. So gearing will either go down or remain same. It is a risky strategy. But matching में what? Asset life is matched with finance or life, correct? Then going into over trading. Over trading में there is a question called Gorwa company. I think it is eliminated from a lot of books, correct? But very good question on over trading, right? Symptoms of over trading. Over trading or under capitalization. It is a situation where you want high sales, correct? With low or under capitalization in working capital. You try to get, you give a lot of what? Credit period, right? To people. But because of high interest rates in what? Borrowing. और दूसरा मतलब क्या है? Sales में a lot of what? High sales with low or under capitalization. So what you do is you try to reduce the investment, correct? Right? You try to reduce the investment, correct? But try to do what? Tell me. More and more sales, right? So more and more sales may you give a lot of account receivable period. So there are liquidity problems. So your sale increases, your profit also increases, but there is a liquidity problem. So if generally asked, let's say theory question also over trading pe asked, that write a short note on over trading and the symptoms of or what? Conditions of over trading. The four conditions basically are rapid rise in sales, right? Coupled with fall in gross profit ratio and net profit ratio, right? And if a practical question comes up like Gorwa company, correct? You will calculate all this, right? So what you will do? Rapid rise in sales. Have a look. 37,400 is the sales for 2007. 2006 it is 26,720. Correct? From 26,720 it will go to 37,400. Means there is almost 30-40% rise, right? But GP ratio. The GP ratio has gone down considerably, right? You find out GP ratio, that is 2939 divided by the sales and 2992 divided by 37,400. How much is the percentage? There is a fall in GP ratio that is there, right? Then you will see fall in GP and net profit both ratio. Then account receivable period will go up, inventory period will go up, account receivable may go down or remain the same because you are going to pay everyone on time or pay them early. and cash operating cycle will go up, right? Then if there is a rapid fall in liquidity, that is current ratio and quick ratio. Rapid fall means not 5-10%. Generally not 2.5%, more than 10 or 15%, there will be a rapid fall in liquidity. Correct? Right? Current ratio and quick ratio falling. And the last, all the major investment in working capital, this account receivable and everything is done by short-term sources, that is overdraft. So you have to look for symptom here. You should look at what? How the money. Now see here, investment in working capital, inventory and trade receivables have gone up here, right? So you look at liabilities, where liabilities have increased. Equity share capital raised has not increased. The bonds have not increased, but the current liabilities have considerably increased. Correct or not? Have a look. Current liabilities have considerably increased. The overdraft has increased by 1625. So logically, you have funded what? All the working capital through what? Tell me, short-term sources. Correct? If all four conditions are fulfilled, your company is overtrading. If any one out of the four conditions is not fulfilled and a practical question plus theory mixed question is asked, you should write that the company is on the verge of overtrading and management should take care of the same. 5-10% is normal fall. Generally, more than 10-15% is a bigger fall. Correct? Then here you have 2-3 good questions. I have noted or done a lot of questions here after the part has been completed, right? Here, very good question of this inventory has come up once in exam, right? So working capital management, wait, right? So here I told you Gorva company. One more question from basics of working capital management, I think was Puma's company. Puma's nahi, ek minute. हाँ एक was there Dusty नहीं Puma's I think something was asked no हाँ effect of proposed expansion, yes. So they are given what? Inventory holding. So Puma's company is one thing that you could do, correct? Then Gorva company already I have told you, correct? This time Guillermo cash operating cycle was asked, section C question. So now they have gone into that part. Guillermo, GUILLERMO. Guillermo company's cash operating cycle has been asked. That you could do, correct? Guillermo, okay. GUILLERMO, Guillermo, correct? Those are for basic working capital management, right? Then your advance and HGR company is also one good question, correct? But HGR company, the first part, discuss the working capital financing strategy of HGR company. You have to look at the working capital financing strategy they have given here and talk about it, correct? Yes, you could do. Then Ajao Zara to the question or account receivable and account payable. Most important chapter in working capital, account receivable and account payable. Correct? Ajao Zara. Your basics of working capital management. Ajao Zara, main table. So objective of account receivable management, improve your cash flows and the credit management, improve customer satisfaction because what you will be paying or you'll be providing good management of your account receivable, reduce bad debts and boost in profit and boost in sales value. Correct or not? Right? Components of account receivable policy. Your formulation, policy ka formulation, assessing credit worthiness of what? New customer and existing customer, prompt invoicing and follow-up and aging analysis. 4 things. In that, obviously, where will you how will you assess the credit worthiness of new customer and existing customer? You will look at the published financial statement, past track record of the company, credit report or civil report, sales history or record, asking the competitors, correct, about the customer. Then prompt invoicing and follow-up, right? You invoice, you follow up, you call, send letter, send legal notice, and if not, anything, then factoring and other options would be used. Then aging analysis, correct? Have a look. Right, from here you go ahead to account receivable basic calculation. How do you calculate account receivable? So account receivable balance is given or days are given and you have to find account receivable balance. You can do that. Finance cost of account receivable. How do you find out the account receivable balance into the finance cost? Or you could do what? Finance credit sales into AR by 365 or 52 by 52 or 12 into the short term borrowing rate percentage. Discount given to account receivable. Two types of methods are used. Again repeating. First, most books had the view of using compound interest formulas. So if you look at old books, right, the compound interest method would have been used everywhere. But now the ACCA has gone and said that simple interest method is the default route where discount of account receivable is to be done and 100% of the customer accept the offer, right? So here default method mein what is the formula? You first find the true discount. What is the true discount? So $100 ka bill, 100 minus 2%, $98 is the amount that you pay. So you got $2 ka discount on 98. So 2.04% is the true discount percentage. Barabar hai? 2.04 for 12 months, correct? For 2 months, right? How much for 12 months? So you do 2.04 into 12 by 2. That is 12.24%. But if they said what? Tell me. If they say that the same thing, when compounded turns out to be 2.04, you do what? 1 plus 2.04 raised to 12 by 2. That is 6 minus 1 gives you 12.88%. So if they ask you effective annual cost of discount of account receivable, then use this formula. But if they tell you to use what? Nothing given in question, then simple interest method is the way to go. Sorry, but this is how your study hub has taken a view on this part. Correct? Have a look. Correct. Company B has given discount 1.25. So you generally in this amount of invoice is not given. So you assume amount of invoice to be 100%. Correct. Then go ahead. Discount to account receivable. Have a look. If only certain percentage use it, in this you will use existing versus new system. Existing may there are two costs generally, the finance cost of account receivable and bad debts or the other cost, versus the new system that is there, discount given, right? There will be discount cost, right? Then there will be finance cost of account receivable where you're lower, right? Certain will pay in 30 days, certain will pay in 40 days. Accordingly, you have to make a table for it. Then there is a bad debt cost or other cost of savings. This too, I think most of you might know how to do it. One of the simplest part of account receivable is this. But if you have done from certain books, right, self-study or certain that part, then in that case, you must have done from book and you must have done by net method. We don't do by net method. We do existing versus new system. Have a look. Just say we do this candy company. Have a look, candy company. We do solve it like this. Wherever you have what lower cost, that option is better. Or they ask you what is the additional cost of going into the new system. This is the additional cost 16,250 to going from the existing system to the new system. Always try to do this, right? But if you are comfortable with what, tell me, already comfortable with the method that book follows, no tension. Correct? Have a look. Right? Discount is always calculated on sales, right? Not on account receivable. Due to discount given, there might be increase in sales and increase in profit. So if there is an increase in sales and increase in profit due to the same, you have to account for the same. Fleet company, right? Fleet company where there is a hidden adjustment, you should do fleet company. Fleet company. Fleet company ka question of account receivable is an important question. See, obviously, we have done candy company and fleet company both. Fleet company mein, right? You should do fleet company, right? Increase in profit they have taken here as a cash flow, correct? So when you are writing costs, here I am writing all cost in positive, then my savings will go in negative. Yaad rakhna. This happens a lot of times, correct? Fleet company is a important question, correct? Fleet company, right? Then factoring, practical and theory both are there in factoring. Factoring is what? Basically, you get a what? Person. Now see in bill discounting, what happens? You discount your bill with bank or financial institution, right? They keep the bill with them, give you 80% of the bill as advance, right? And then you use that money when after 30 or 60 days, when you receive the money from your customer, right? You pay back the amount 8,000 plus the interest, correct? And remaining you have in your hand, correct or not? Then what? When it is factoring, you do not, or you sell your invoices to the factor, and the factor will take the money from company B, and he will cut his factor fees and other expenses and give it to you, right? That is how flow of money goes in a factor. Factor is generally nothing but a munna bhai or what, a goon who helps you. But don't write that in exam. Factoring is a proper what? Tell me, organization who are trained to get money or recover money from people, right? Generally, they are used by what? People who are not from business background and do not know how to manage account receivable, account payable, correct? Hence, this process is outsourced, right? They cannot take the money in 30, 60 or whatever credit period they have given, right? And then there is what types of, right? It is Munna Bhai only, correct? I tell that in class. It gives you better example or better understanding of what factoring, correct? Then factor has two types based on bad debt responsibility and based on advance provided. If it is on bad debt responsibility, recourse factoring, non-recourse factoring. Recourse factoring means what? Factor doesn't take liability, right? It recourses back to you, right? Bad debt liabilities is the company. That is the company who takes the factoring services. Non-recourse factoring is basically factor takes responsibility of bad debt. The bad debt does not recourse back to the company, correct? Your factor fee will be higher, your factor fee will be lower. Generally based on advance provided, factor could be advance against what account receiver will be provided, and where no advance will be given. Generally, advance given by factor will be at a higher rate than the short-term borrowing rate of the company. Then I have said that there are four possible types of factor that can come up. 1 and 3, that is recourse plus advance given, or recourse and no advance given. Then non-recourse and advance given, and non-recourse and what? No advance given. All four options are open, correct? Relevant cash flows are basically in a factoring question or a factor. So it will be again existing versus factor, correct? So existing है और factor है. Existing है उसमें normal cost of foreign currency or what finance cost of account receivable, bad debt, anything that is there that will come up, right? And in the factoring, correct? You have either one or two options given or only one factor given, correct? You will have the factor fee, saving in admin cost, finance cost of account receivable, bad debt, finance cost of advance receivable. Now see, all the account receivable has to be funded from outside. If factor gives you advance, see, factor will also say your account receivable days will be 70, 80 days, 60 days. You will say, I will give you your money 30 days, and he will give you advance, for which you have to pay what? Cost of or your 30 days ka kya? Tell me, finance cost, advance. And remaining 80% you will give advance, remaining 20% you have to do from bank, correct or not? So that is how it is. Oscar company is a question, right? Which you can calculate. Now see there in Oscar company, if you have a look, your Oscar company is there. We have done this existing system option 1, option 2, right? Here what you could do, see, I took a cost of bad debt here. They had given here that bad debt of the company is 560,000. In option 1, it was recourse. So I took the bad debts here because bad debts were what? Incurred, because company had to take the risk of bad debt. But when it came to what? Non-recourse, here company did not take the what? Tell me. Hit of bad debt. Bad debt was taken care by the factor. So I took bad debts for the company as 0. Here in both these cases, I took 560, 560. Now another option of showing this is what? Showing this 0, showing this 0, correct? And showing this as minus 560, that is savings of bad debt. Answer will not change. All the decisions will remain the same. Just a different way of showing it, correct? Like cost savings, right? I could have shown cost here 30,000, correct? Extra. And then do here 0 and here no admin cost. Here 30,000 ka cost, no cost here. My decision or my what value won't change, correct? It will all remain the same, correct? So these are two ways of showing. I've shown you two ways. Show cost where incurred and 0 where saved, or show 0 where incurred and savings where cost is saved. And if all costs are in positive, then savings will be negative, correct? So how the questioning asked? According to that, you do what? Tell me the working. Then factoring the theory is also something that is very important. LDR question. I think twice or thrice it has been asked in the last 10 papers. Factoring. Advantages, disadvantages. I cannot even tell you such straightforward question. Correct. But lot of students don't only do that. Completely miss it. Q. Sir, we don't want to do it only, sir. Right? Not required at all, sir. Correct or not? Not to do it. Why? Sir, very boring. But if you get it, honestly, I'm telling you, right? 6 or 8 months, free 6 or 8 months. Advantages. They provide advance at higher percentage than what bank OD. Bank OD gives 50-60%. Your factor gives 80-90%. Factoring helps save admin cost of account receivable. You can fire actually the whole account receivable department. Better assessment of credit worthiness. Factor knows everyone and what is their paying habits. And they can do a better assessment of what? Credit worthiness of customer. Right? And factor provides insurance against irrecoverable debt. Correct? Irrecoverable debt against it provides insurance. But disadvantage is what? They charge a very high interest rate compared to bank OD rate. Factor will intervene. Now they will tell you, "Arey, this customer don't sell because he does not pay on time." They will intervene with the credit decisions. Correct? Customer would not be very comfortable dealing with the factor because factor is going to ask money from customer. Right? Factor may take extreme action, kidnapping. Correct or not? Against customer without consent of client. Factor employed may mean that companies having liquidity problem, which may go in the market as what? Liquidity problem. This will be market feeling, and thus customer supplier will not be able to trust company. With account payable management, right? Here, oddly enough, I'm telling you, my prediction in the paper, account receivable does not come up, account payable will come up. Because honestly, more popular is account receivable and factoring and all that, but less popular is account payable. I'm telling you. And you will not be able to judge only that the question is for account receivable or account payable. You might say with a lot of confidence, but when it comes up in exam, a lot of students I've seen are not able to judge at all that this question is what? Tell me account receivable or account payable. Correct? Then simple interest, compound interest, right? Same cut copy paste account receivable का जो part है, that same part will be used here, right? Have a look, right? Only the decision criteria, right, is same as the account receivable management. Short-term borrowing percentage is greater than annual discount rate, right? Borrowing is more, annual discount rate is less. Then discount ko you choose discount, right? Short-term borrowing rate is what? Smaller than the annual discount rate, then no discount, correct? Have a look, right? This has no logic, but most of the books use this. Now, don't ask me why, don't ask me how. At the last time, just learn it and go to exam, right? We have discussed in the main class, we have discussed this part in detail. So, invoice value given to you, no invoice value given, then you consider account payable ka what? Annual interest that will become. If invoice value is given, then finance benefit of account payable, other benefits and cost. Here, you are going to write benefits in positive. So, if there is any cost, you will write in negative, right? Here, discount benefit received, then finance benefit of account payable, correct, and the other benefits and cost. For this question, important, Nesud company, you should check out this question, correct? Nesud company, write down Nesud company, very important question. Here are Nesud company. You have the question here, maybe not there in your book, but it is there here, correct? And Widnar company also, you could do Widnar company, correct? Good question, right? Sure. उसके बाद let's go to what? Working capital management. In working capital management, inventory management, correct? In inventory management, the basics of inventory management, if you keep it very high, keep it very low, then what will be the problem? Liquidity versus profitability. Then you go to EOQ or ROQ. First, actually, what is ROQ? Or there are in total inventory cost, there are three costs: purchase price of inventory, ordering cost, and holding cost. Correct? Purchase price of inventory as the annual purchase price. Generally, it is fixed all over the year. Correct? Ordering cost is generally the admin cost, transport cost. Most important, transport cost is included in ordering cost. An annual ordering cost is a total of total admin cost, transport cost. Holding cost में storage cost or warehouse cost Then finance cost of holding inventory, correct, is nothing but annual holding cost, correct. Now, if you look at this, right, ROQ is nothing but a reorder quantity. So I must have done the formulas. So what are the formulas? Annual purchasing price is nothing but an annual demand in the purchase price per unit. Sometimes annual demand will be given as a monthly demand. So monthly demand into 12 or quarterly demand into 4. Annual ordering cost is nothing but the annual demand divided by the reorder quantity. Reorder quantity is nothing but that quantity you order every time, correct? Into cost of ordering per order, right? And then when it comes to annual holding cost, it is ROQ plus 0 divided by 2 into cost of holding per unit per annum, correct? Now, the two things, right, that you need to understand here, right? ROQ is actually there in the formulas. You must have taken EOQ as the formula. EOQ is not in the formula. ROQ is the formula and EOQ, have a look, right? EOQ, if you see the formula for EOQ, right? EOQ or the definition of EOQ is what? EOQ is that reorder quantity or that ROQ at which the annual ordering cost and annual holding cost are minimized, right? These two costs can be minimized only by using what? EOQ. That means ROQ at which what? So it is going to be that quantity that you reorder every time so that the annual ordering and holding costs are minimized, correct? EOQ का formula is square root 2 into annual demand into what? Cost of ordering per order divided by cost of holding per unit per annum, right? Now there is this, right, part where generally what will happen? Annual ordering cost and annual holding cost will be same at what? Tell me the EOQ. That will be there. Buffer inventory will not have an impact on what? EOQ ka formula, correct? Right? But yeah, will the things change when buffer inventory comes up? Yes, no tension on that front. But impact of buffer inventory will happen on what? Have a look. Annual purchase price के ऊपर buffer inventory will not have an impact. But annual ordering cost also buffer inventory will have no impact. But when it comes to annual holding cost, buffer inventory will have an impact. So how does the impact come up? So generally it is average inventory or ROQ plus 0 divided by 2. With buffer inventory coming into the picture, the formula of average inventory changes to what? ROQ by 2 plus buffer inventory gives you average inventory with buffer inventory, correct? And then you multiply it with by what? Tell me. Your normal question that is there, right? And or cost of holding per unit per annum, you get the cost of holding. Now finance cost, which is included, correct? Finance cost, which is included basically in your what? Calculations, right? उसमें problem क्या है? At times finance cost is included into that holding cost. Finance cost included into that holding cost, correct? And but when it comes to section C, so in section A and B, when you are calculating EOQ, right? Finance cost will be included into the what? Holding cost. Like you have 2-3 questions here. Here you have included the finance cost. Generally, finance cost will be given what? Per unit per annum, how much is the cost, correct? But when it comes to section C, like example, have a look at Dusty company, correct? While calculating EOQ, Dusty company में क्या करें EOQ, हाँ. While calculating EOQ, right? The interest cost is not included. In section C, generally interest cost is not included, correct or not? It is shown differently. देखो इधर annual interest cost. Keep this in mind. But when doing section A and B questions, what will happen? That will be included. That is the problem with finance cost, right? Then EOQ versus bulk discount. The ROQ will increase and you will have discount. So selling price will change. We have a question here that we have done. I think ये वाला क्वेश्चन था या रोहित कंपनी क्वेश्चन था बल्क डिस्काउंट वाला, राइट? और we had solved one question here, correct? So the selling price will change. किया था ना one question? I don't remember. ठीक नहीं किया होगा, but there is this question that you can do. उसके बाद assumptions of EOQ, very important theory questions, correct? Has come up in exam before. Demand is constant and known. Every month the demand is constant and known. Lead time is known and constant. Lead time is 0 is not an assumption. Lot of MCQs have this question. Purchase price has to be constant, obviously no buffer inventory. And note, annual holding cost equal to annual ordering cost. Then comes the part of reorder level, right? Reorder level is nothing but the max consumption done in the max time for which an order is received. That means whatever max lead time into max consumption. एक important question और some different question है, वो एक बार आप देख सकते हो, but not very important from example. JIT, LDR question. JIT out of last 10 attempts, 2 to 3 attempts, JIT has been asked. Very important question. Either it is characteristics of JIT, aims of JIT, or benefits of JIT. तीनों में से कोई भी एक क्वेश्चन कैन कम अप इन एग्जाम. Characteristics and aims are almost same. Correct. Benefit is a important question. Either there are JIT system in what? Supply chain process system, where inventory is reduced or completely eliminated. Right. It not only looks at inventory but looks at all the processes in the business. They want to smoothen, streamline all the manufacturing process, right? And zero waste or no defects is the policy that is there, and everything happens as per customer requirement. No stock to be kept. Items are only produced after an order has been placed. Little room for error. Higher quality, correct or not? Good supplier relation, because you want orders faster. So here what will happen? Number of orders will be higher and annual ordering cost will be higher. Correct. Frequent deliveries of small order. Aims of JIT are smooth flow work. Right. You want the material to be passed very smoothly. No waiting time, nothing. A flexible production process which changes as per the customer's requirement, and reduction in capital tied up in inventory, because you are not going to keep any inventory at all. Correct. Then benefits. What are the benefits? Have a look. What are the benefits? Yes, you have to write it point. Obviously. Correct. Benefits of JIT. Not even a single question you should write in paragraph form. Every question you should write in point form. Right. The more clear you are about every point, the more better scoring will happen in exam. Correct. Now see, benefits of JIT is what? There is operational efficiency because production process is completely streamlined. Unnecessary steps are eliminated. Lower reworking costs as quality material is bought and production process is streamlined. Correct. So you have best quality material, so no reworking or nothing. Benefits of JIT: low investment in working capital as inventory will be kept at minimum levels. Storage cost of inventory is reduced. Correct. And low material processing cost due to proper handling of material throughout the production process. You don't have to look at anything else. And better relationship with supplier. Even if you have to pay extra to supplier, do that if he's giving quality and on time. These are benefits of JIT. Has come up so many times in exam. I'm first only telling you, don't rely on anything else, but this is very important, right? The theory questions that I am marking one by one. Correct. Then you have your last part of what? Cash management. 3 reasons for holding cash. What are the 3 reasons for holding cash? Tell me. 1 minute before we go ahead. EOQ का important question. I think एक तो डस्टी कंपनी नहीं, EOQ है कैसे? डस्टी कंपनी कैन बी डन. करेक्ट. डस्टी कंपनी. एंड कोई भी एक क्वेश्चन ऑफ व्हाट? बल्क ऑर्डर डिस्काउंट कैन बी टेकन. राइट. चलो, वर्किंग कैपिटल मैनेजमेंट, कैश मैनेजमेंट. 3 reasons for holding cash. What are the 3 reasons for holding cash? Transaction motive or motives of holding cash has been asked in exam before, can be asked in exam going ahead. Correct. Transaction motive for day-to-day transaction, precautionary motive for emergency transaction, and speculative motive for earning returns. So you invest the money somewhere, right? Then you have what? Cash management models. You have the Baumann model and the Miller model. Baumann model is nothing but the copy paste of your EOQ. It is nothing but the, if there is savings of cash, correct, investment is done. So it is nothing but the amount or optimal amount of investment to be done or investment to be sold. Agar if there is extra cash, you do investment. If there is shortage of cash, you sell the investment and bring it back. So the optimal amount of investment that you need to do every time, correct, for reducing the what? Your cash may basically holding and transaction cost of investment that is there, right? So same 2 into 80 into COPO by cost of holding or cost of holding per unit per annum. Here it will be cost of holding what? Tell me. Cost of or opportunity cost of short-term borrowing per cent per annum, basically, right? And your COPO cost of ordering will become cost of transaction per transaction. Those are generally directly given in exam, right? So this is how it works out. You can have buffer cash also. Nowhere in your book buffer cash is there, but I have given one question of buffer cash. Also, I have given proper notes of what happens where, right? Then you have the Miller model. Miller model helps you analyze what you are given the lower limit of cash. So it helps you in holding cash. How much cash should be held at any given point of time, right? So you are given a lower limit, right? You have to calculate the spread from lower limit to upper limit and also calculate the return point Z, correct? So the spread calculation formula is 3 into bracket open 3/4 transaction cost into standard deviation of cash flow or variance of standard deviation square or variance of cash flow divided by interest rate per day, the whole raised to 1/3. Variance is equal to nothing but standard deviation square. If standard deviation is given, you take square of that. Variance is given, take directly variance. Transaction cost per transaction 3/4 is something that they have given, divided by only, you have to understand or remember, interest rate per day is given and not per annum. So if the 7.2 interest rate is given, you will take what? Tell me. 7.2 divided by 360 or 365, whatever is given in the exam, right? So once you find the lower limit is given to you, find the spread, you get the upper limit. Upper limit के बाद you want to find the return point. Return point का formula is lower limit plus 1/3 spread. With that you can find the return point that is there. Have a look. Right? Deposit reduce. When it is in Baumann model, your opportunity cost is to be used. So in Baumann model, if they give you rate of deposit and borrowing, so you take the difference between both. So depositing ka rate is 5, borrowing ka 9. Then you take 9 minus 5, 4% in what? Opportunity cost of holding. Then there is something called as cash budget, what? Balance sheet method, right? Have a look. Here generally a balance sheet is given and certain what adjustments are given. You have to do the adjustment and find the new balance sheet. Even you have what Umais company एक question है. Umais is उसमें भी the balance sheet is asked. Correct. You could do that Umais company. It is what basic and abhi wala question both, right? Mixed, right? So everything you have to give a what adjustment should be given or adjustment should be done, and you should find what the next year ka balance is, correct. Then cash and OD ka balance you should not calculate now, right? At the end you should calculate it, correct. So wherever you are having a shortage, correct, there if the assets are short, then cash will be there. If liabilities are short, OD will be there, correct or not? I will. I've given the full process also, correct. Then cash flow, cash budget. Cash budget has a format. There is a question called as split company. This cash budget has come up. I also have 1 or 2 questions that I have given, right? But I think split company cash budget question. See, I have given one cash budget question. Have a look. It is there in the notes. I have dictated that question, or I must have copy pasted that question. Correct. Then I did certain basics of MA for understanding what? Tell me. Cash budget. Yeah, and company, if you want to do it, you can solve it, right? Similar question is your fleet company question. What question? Fleet company may also cash budget is there. You could do that. Then there is something called as ZSE company, right? Which I have done in class. It is a good question. Advanced question of what cash budget, right? ZSE company. You can do this question, correct? With this, I think most of your part, right? Equity yearly installment EYI. If you have to find out what is the formula, tell me. The principal loan amount divided by the annuity factor, loan rate percentage, comma, and this. You will get the equity yearly installment in which the loan can be repaid. With this, tell me, almost most of your portion, I think 50 to 60% of your portion is done, and in record time of 3 hours. Now, what question to do in cash? Okay. Cash में I think most of the questions, right? Cash budget हो गया, Umais company I told you, ठीक है, more than enough, right? Cash का there are very less questions, okay. So with this I think NPV, working capital management, done. Now remaining what? Theory. So what I'll do is tomorrow I'll take some theory and day after tomorrow I'll take some theory. So you don't have to worry about theory. So now what is your task? I'm leaving you early, correct? The reason is only one and only one. ऐसा कुछ नहीं रितिका, right? It is not that investment appraisal question only will come up in section C. Nothing like that. That one question will be investment appraisal for sure. I have seen attempts where one working capital has come up and one cost of capital has come up. So no one can guarantee tell you. PDF of theory very nahi hai. All this theory is there. You go through the notes. Abhi notes to full I have given. Correct or not? Right? Go through the notes. I have marked what are important theory questions. Correct? You can go and do those. Questions come up from there only. I am telling you theory questions for section C. If you have not yet done, kindly do it. It will help you score 12 to 15 marks in exam. Out of that 40 marks, 10 to 12 marks aram se. In theory, it will come up. Correct now? Right? So now what is your task? Right? The first thing that you should do, right? Yes, cash flow forecast is important, madam. Yes. Yes. So I would say that go through all my notes of working capital management and solve the working capital management questions. I have given each and every question ka what. Yes, I told you write in point, right? So no need to write in paragraphs. So today first task, right? Solve all the section C questions of investment appraisal, working capital management that I have marked, right? Section A and B, whichever you have marked as difficult, do all the questions. Tomorrow, once you are done with Forex, so up to day after tomorrow, you have Forex, interest rate risk, business valuation, and one theory chapter that is there. These 4 chapters I will do. Day after tomorrow, WACC and sources of capital, and one theory chapter that is remain. Done and dusted. Usme dividend policy will also come in WACC. So with me now, start solving. Now you have 6 p.m. From today to up till tomorrow 2 p.m. Solve as much questions as possible. Because tomorrow you'll have what? This now, today if you start now, you can go up to Tuesday evening. Because section C question of it, tomorrow we do Forex. Forex only A and B question. So no tension per se. But day after tomorrow, right? You will have again section C question. So WACC again you start solving. That's why I've given 1 day in between of Forex. So you have 2 days for your investment appraisal and working capital. Solve all the questions that are there of investment appraisal and don't just solve it like this. Solve it on Excel, proper format, or something like that. Right? That is how you tackle what? Tell me. Read all the notes, right? The notes are very concise to the points, but has all the concepts that you need to solve every question that is. Okay, then we can wrap it up, right? I hope you all found some value addition because of whatever we have done. Tell me. I hope I could even if 5-10% I could add to your marks by doing whatever we are doing from 45. Even if you reach to 50, that is the goal. Okay. So simple and sweet. Right now also, if you start doing my notes with whatever you have done, right, most of the things are manageable. And those who have done class with me know how concise and precise the notes are. Every MCQ, most at least 85 to 90% MCQs can be solved with just my notes. Okay. So now it is your task of doing everything one by one, right? All the best to you tonight. Go for it. Today, if I would have been on your place, today 7 or 7:30, I would have started, sat till 1 or 2 in the night, right? Maximum whatever I can do, I would have done maximum everything that is there, section A and B. Tomorrow morning, I would have woken up early, 4, 5 or 6. From 6 to up to 12, 12:30, right? In that 6 hours, I would try to solve each variety of investment appraisal and working capital management. In the evening, or today, if I do today and tomorrow, if I do section C, after tomorrow's class, right? Someone do it, put it into the group, okay? Right? So those many questions, 10-15 questions, right? So you have up to Tuesday at 2 p.m. to solve all in your questions. And then Tuesday ke baad you do WSCC Wednesday, and Thursday you do remaining section A and B. Friday you are okay for, or Wednesday, Thursday you could revise everything, right? After the class is done in those 2 days. Friday you can go in the exam. Okay. Chalo then guys, have a good study session, right? Take care of your health. We will meet tomorrow 2 p.m. and then take care of your health. Bye.
Bye, sir. Thank you, sir.
Bye.